start it.
There we go.
I think we're on. All right. Well, hey, welcome everybody, and welcome everybody online. I'll be keeping track as we go through this from the back of who all we have online. But one thing to mention too, I think it's probably safe to say that questions are welcome, and we'll actually be turning on this thing here that lets people out there ask questions too. Let's see, I'm Steve Morris. I manage the Oregon Technology Business Center, OTBC. The really quick version of what we do is we're an incubator for tech startups. So what that means is we provide office space, but also you get the mentoring and the workshops like this as part of the deal. So we basically help startups start companies, and our mentoring in particular has gotten some very high ratings. So it's a good place to come to get started, and we're conveniently located just almost right next to a Max stop, and so it's pretty easy to get here even via mass transit. That's the quick story on OTBC, and by the way, I should say, by the way, we have space, so we're definitely looking for startups. So certainly, if you want a place to start a company, love to talk to you. And with that, into today's program, which is pretty exciting, a new source of funding. New sources of funding in general are a good thing. This whole community public offering concept, a brand new law from just last month here in Oregon. And you'll hear all about it from Tonkon Torp. And with no further ado, I would like to turn the floor over to Dre and Claire. And thank you both.
Thank you.
For joining us today. Why don't you go ahead and introduce yourselves, and then I'll switch over slides.
Yeah, definitely. So I am Drea Schmidt, and this is Claire Brown. We are both startup lawyers at Tonkon Torp. It's a firm downtown. Claire and I also both do securities law. So we spend a lot of our time dealing with companies and ownership equity issues. And in that regard, we've talked a lot about the many, many different types of crowdfunding that are out there right now. And that's what we're going to talk a little bit about today. I think we're ready to go.
And with that, we are going to make a switch here over to the slides. If I can remember how to do this. Now somewhere. Oh, there. Voila. All right. Oh, and
allow. That'll hide this guy. Nope.
Okay, sure. Okay, so I'm going to tell you to start a little bit with what the broader landscape for crowdfunding, and a couple of things that we're actually not really going to talk about today, but it's kind of helpful to give you a little bit of context to start with. So crowdfunding at this point actually means a number of different things, but in its broadest sense, it means raising small amounts of capital from a large number of investors. And at this point, it usually means using the internet to do that. There are a couple of different kinds, as I said. All of you are familiar with the Kickstarter model, I'm sure. The big distinction for our purposes today of the Kickstarter Indiegogo model is that in this case, you're really not talking about a security. So you're not talking about selling an ownership interest in your company. Instead, you're talking about pre-selling products or giving some sort of reward in exchange for what is essentially a donation from donors. Another form of crowdfunding that you may have heard of before is something that we call accredited crowdfunding. And this is a type of crowdfunding that really involves soliciting money from accredited investors. So these are basically folks that have a certain amount of income or a certain amount of assets such that they qualify as accredited investors. And under some new rules that are out there, you can actually do very broad, wide advertising under this accredited crowdfunding model. But again, the drawback here is that the only folks that you can take investments from under an accredited crowdfunding model are accredited investors. And so in terms of looking at the landscape of investors, in general, we say accredited investors are sort of the 1%, and non-accredited investors are the 99%. And so for that reason, people have been really excited about having the possibility to raise funds from non-accredited investors, from the 99% of people that are out there that are really Main Street as opposed to Wall Street. So in that regard, back in 2012, Congress came out with what we like to call Main Street crowdfunding, which really allowed companies to raise capital from any type of investor without taking into consideration their wealth or sophistication as an investor. And people were really excited about this, but again, that's been 3 years by now. And part of what happened in that 3-year period since Congress first came out with it is that the SEC came out and said, okay, so we're going to let you take money from non-accredited investors, but we're also really worried about making sure that we're taking care of those non-accredited investors. So they tacked on quite a few rules and restrictions onto the Main Street crowdfunding concept, such that it ended up being a pretty expensive way to raise money. And under Main Street crowdfunding, you could raise up to $1 million in any 12-month period, but by the time you got your reviewed and audited financial statements and did all of your disclosures and ongoing disclosure requirements, we think it will actually be really pretty expensive for people to do a federal Main Street crowdfunding offering. And to top it all off, the SEC has not adopted final rules. So when it comes down to it, this is not available yet. So up until this point, when Oregon adopted their Oregon crowdfunding exemption last month, the opportunity to raise money from non-accredited investors on a grand scale really has not existed.
Andrea, quick comment, just for people who are watching. Want to note that Tom, just to test the questions, asked, "Why is the sky blue?" And I wanted to mention that just to let Tom know that yes, indeed, for everybody out there, we can see the questions. So I'll be piping up with those, even though they don't display on here. They're going out there. So I'll let you know.
Definitely.
Questions come up, and you don't have to answer that one.
Okay. Thank you. So Claire's going to start to dig down a little bit on the details of the Oregon crowdfunding exemption.
Right. So as Drea mentioned, people were really excited about the idea of being able to access the capital held by people who were not accredited investors. Again, the dream is you take $20 from this person, $100 from this person, and they're all enthusiastic about your idea, and that gives you the capital you need to start your business or move your company forward. It's very frustrating to people that Main Street crowdfunding isn't available yet, that the SEC not only have these very burdensome rules that they're proposing, but that they haven't managed to finalize those rules and give people a way to use this sort of crowdfunding. And there's a lot of political will around opening this sort of investment up to small companies, or to early stage companies, I should say. So that got channeled into support around state crowdfunding. Last time I checked, there were 26 states that now have state crowdfunding, and every time I say a number, someone corrects me and says, well, no, actually now there are even more. So it's at least 26, but some large number. This is really sweeping the nation. This is all in the past couple of years. People have managed to write and pass these state-specific crowdfunding regulations. So a few broad traits for all of these states. They have different priorities. There are different people pushing the legislation, but there are some commonalities that we see. First of all, in all cases, offers and sales have to be restricted to the residents of a single state. This is just the way the rules work. There's not a way around it. You can only fundraise from residents of the state. Every state is capping the total amount raised. The theory here is that if you can't raise that much, you can't really defraud people too very badly. This is an investor protection limiting the amount of money that any company could raise. Almost every state also caps any amount that individuals can invest in an offering. That's the same thing. It's an investor protection, and it's usually based on a person's net worth, or there's an absolute cap and no one can invest more than that amount, or states do it differently, but that's a common trait as well. Also, people are irritated at the Main Street crowdfunding rules. when they came out, the part of the internet that talks about securities law was all up in arms, and people were saying, no one's going to use this. No one's going to use this. It's too complicated. It's too expensive. So states have made an effort to be friendlier than the Main Street crowdfunding rules. And there are states like Washington State, for example, their state crowdfunding rules look very similar to a pared down version of Main Street crowdfunding. A lot of similarities, but 1/20th of the length. Some states go in different directions entirely, but that seems to be something that people are very determined to do, is be nicer than Main Street crowdfunding. Another commonality is that this is really meant for small local businesses. The language around when these rules are adopted, the people who talk about why they're important for the state, it's all economic development, job creation, local, 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 local investors, local businesses. This is really emphasis in every case that we've investigated. And it's also really smart politics. Those are easy things to get behind. There's no one who's going to say that they're not for job growth or economic development in a local area. And there's a lot of support behind getting this stuff done, which is why it's now in 26 states in just a couple of years. So enough about the whole US. Let's talk about Oregon a little bit, because now we have community public offerings. So a couple things to note. We won't go over the nitty-gritty of all the rules, but there are some things that we really want to call out because they're going to be important if anyone's considering using this. First of all, this is Oregon small businesses making offers and sales to Oregon residents. There are a couple things in that. First of all, a lot of companies that are startups or that plan to fundraise incorporate in Delaware, because that's what you do. You can't do that and use this exemption. This is only Oregon companies. And that's going to knock out a bunch of people, even in Portland, going to knock out a bunch of people trying to access capital in this way. Also, it's only small businesses, 50 or fewer employees. This, most startups aren't going to have more than 50 employees anyway. So, but what they're trying to say is that big businesses have other access to capital. They're not going to need this. We don't want them to use it. Offers and sales to Oregon residents. This is tricky, and this is going to trip people up because an offer is a really broad concept. Anything that conditions the market to think favorably about your company can be considered an offer. And as soon as you make an offer to someone who's not an Oregon resident, the exemption's gone. You can't use it anymore. So in Portland, there are people who work here and live in Vancouver. They're not Oregon residents. There are people who have vacation homes in Bend. They're not Oregon residents. This is something that's going to take a lot of thought, and that I think it's going to trip a lot of companies up who maybe are a little free with saying, oh yeah, we're fundraising. Anyone out there want to invest? Or putting up a sign in their cafe window saying, look at our great public offering. That's gonna be a problem.
Yeah, so this is really one of the tricks of the Oregon public offering exemption, is that you have to structure it in such a way that, first of all, you have to be an Oregon company, and you have to be making offers and sales only to Oregon residents. So there are a couple, and they've talked a little bit about what that means. So if you have a website, for example, part of what we're seeing, and we're seeing this already, is we're seeing that someone has to certify that they are an Oregon resident before they can see anything about the actual offering. And that's just the offer, right? So when it comes to the sale, you have to do a little bit more. You actually have to get documentation that the person is an Oregon resident. And under the rules, that may mean a copy of their driver's license, a deed, something from a government agency that was sent to their address in Oregon. So what companies are going to end up doing is they're going to end up putting all of that in their files so that they have the underlying documentation to say, yeah, all of my investors were Oregon residents. And I think, if the offering is structured correctly, it's something that can actually happen. But what the part of the takeaway here is that these are really going to be hyper local offerings, very, very local centric. And that's another reason why people in Oregon are actually pretty excited about it, because Oregon really can get behind some of those things. Some of the other aspects of the Oregon Community Public Offering. So we mentioned that there are maximums under the federal Main Street crowdfunding, and under every state. Part of the protection both for companies and for investors is to limit the amount of money that a company can raise from non-accredited investors in this type of an offering. At the federal level, it's $1 million. And again, that's not available yet, so that's not an option for people yet. Oregon opted for a lower threshold of $250,000. And I mean, our understanding from the regulators is that the threshold level is really, again, meant to be a protection for investors, but enough to hopefully get some startups and some small businesses the capital that they need to start moving in a particular direction. The other cap that's important is the $2,500 per person, per investor. So again, at the federal level, that number is a little bit different, and it's actually it's more variable. It varies by the amount of income that you actually have. In Oregon, they're trying to simplify it, trying to say, okay, it's just one amount, $2,500 per investor. But one of the complications that you can see here is that if you want to do your max offering of $250,000, that's 100 investors. And as companies who have taken on investment already know, there are a number of considerations to take into account when you're thinking about having quite a few investors in your company. And as we'll talk about a little bit more in a little bit, there are also considerations to take into account when you're specifically taking on non-accredited investors, folks who maybe are not as accustomed to investing their funds in a company as a professional investor might be. Other requirements that are going to apply to people that want to do a community public offering, there are some disclosure requirements. What they've attempted to do is lay out in a very simple manner the specific things that a company needs to share with investors about its company. And the basic things are information about the founders of the company, their background, their experience. You have to identify all of the founders. You have to talk a little bit about what your company does. That's no surprise there. And what your goals are, what you plan to do with the proceeds of the offering. Another big one in the disclosure requirements is disclosure of potential risks that might arise in connection with the offering. If any of you have ever done a capital raising venture, this is probably something you're a little bit familiar with. In the securities world, we talk about risk factors, about including a list of risk factors. And it's really sort of all of the uncertainties that might come into play with your company. And the tricky thing here is that oftentimes small companies are a little bit hesitant to put in all of the risks that they see as potential pitfalls for their company, because they think that maybe that sort of makes their company look like it's not a good investment. We come from a very, very different perspective on that, in that we see the disclosing the risks and having a really good rock solid list of risk factors as your insurance policy, as your protection from investors who down the road come back and say, hey, you didn't tell me that this or this or this or this might happen. So we try to do as much disclosure as we can to say, you know what, this could happen. We might not meet all of our projected goals. So when someone comes back and says, well, why aren't we quite on target the way we thought we would be? You say, well, I told you about that. And then they don't have an argument, for example, that maybe they should get their investment back, which is one of the risks that we come up with. One of the other requirements, and this is a unique one under the Oregon rules, is the requirement to meet with what's called a business technical service provider. Under the rules, a business technical service provider is generally an incubator or an accelerator or another group that is appointed by the director. And what you actually have to do is just meet with them and go over your business plan. And then you self-certify to the state to say, all right, I met with someone and I went over my business plan. What a business technical service provider will not do is go over your offering documents. What they want to see is what is your plan as a business, and then you certify to the state that I've had this conversation with this particular person.
So there are a couple of other things that we want. Do we have any questions, first of all? I feel like we're
Yeah,
going through
please
this
jump
kind of
in.
quickly.
Please
Yeah.
jump in.
This was my biggest question.
Advertising? Uh-huh. Well, it's a doozy, so.
Arian.
Yeah, I had a quick question regarding the caps. It said 250,000 per offering.
Yes.
Is it conceivable that a company might do multiple offerings, and if so, do they get multiple investments from the same people, or do they have to solicit other people?
You might repeat the questions just to make
Oh,
sure the
sure,
microphone
yeah.
gets it.
Mhm.
It might not hear
So
it.
the question is about there's a cap, an absolute cap of $250,000 per offering, and there's an investment cap per individual of $2,500 per offering. So the question is, can you do more than one offering and thereby take either effectively raise the cap for your company or take more investment from any individual? So there's a securities law concept called integration that we are very careful about. That's basically where you say, yeah, you're calling these two offerings, but look at them. This is really one offering. You're not raising two groups of $250,000. You're really raising $500,000. So with the caveat that integration is a serious issue and is requires a lot of thought and effort towards compliance to avoid offerings being integrated, you can do, you know, one offering closes, you raise $250,000, you start another offering to raise another $250,000. Yeah, and the cap is per offering, so I don't see a problem with that.
So, and generally the general rule is that to avoid integration, if you have the same type of security, so if you're offering common stock and the terms of the security are the same, and you want to make sure that there is no integration between these two offerings so that you don't exceed that $250,000 cap, probably going to need to wait 6 months. The other possibility is that you could offer a very different type of security so that it wouldn't actually integrate with the common stock offering. One of the things that we've talked about is that Oregon crowdfunding contemplates the possibility of crowdfunding debt. So it's possible that you could do a debt offering and a common stock offering under these rules. But this, again, I mean, one of the things that I think is meant to be attractive about this is that the hope is that you can do this without spending too much money on, for example, legal fees, right? Because complying with all these rules is expensive. And so I think from a simplicity perspective, if we had a client that wanted to do both, we would want to carefully structure those offerings so that they wouldn't integrate, and that's going to increase the price of the operation of actually doing the offering. So some things to think about.
Right, but there's no hard limit, like for instance, you can't do two offerings within a certain period of time.
Well, so it's kind of the opposite. There's a safe harbor where if there are 6 months between the offering, it's presumably not going to integrate. So it's not that if it's closer than 6 months, it will. It's just that after 6 months, you're safe. You're presumed to be safe.
Right.
Shark bait's in violation of that rule.
Yeah. Oh, yeah. I lifted
That's
this
good
from
you're
my
paying
Main
attention.
Street crowdfunding presentation and wasn't very careful, obviously,
Yeah,
about my
that's
numbers. You're right. Shark bait is a bad actor. It's going to be excluded from the rules.
That was an example of what not to do.
Right.
Yeah, in the back there.
I have a question. Instead of going through the Oregon Community Public Offering rules and regulations and requirements, why not just go directly to Kickstarter? Is there any advantage
Mm-hmm.
to
So-
using?
It's a good
Oregon
question.
rules?
Yes, and it really depends on the company. There are some companies that have, for example, a product that they can pre-sell on Kickstarter and that is an extremely compelling offering. That's not the case with every company. Not every company has a consumer product or something that they can convey to an audience over, Facebook or Twitter or whatever, and say, come buy this product in advance and I'll deliver it in 6 months. An advantage of using Kickstarter is that you don't end up with shareholders. You end up with people who have a contractual relationship with you, but you don't, shareholders have so many rights in Oregon especially, and you have obligations as a company to deal with those shareholders. So in terms of if a company is trying to raise money in a simple way and they have something that's going to work on Kickstarter, that's a pretty good proposition. But not every company does. It's hard to have an app that can raise money on Kickstarter or something.
And I think part of the appeal of the Main Street crowdfunding and the community public offering is the idea that you have local folks who say, you know what, I would love to own a piece of that pie shop, for example. And they say, it's my favorite pie shop. I love to go there and I would love to own a piece of it. And I think that is part of what the drafters of the rules thought was one advantage. From a securities law perspective, there's much less to worry about with a Kickstarter campaign than there would be with a community public offering. So there are definitely good reasons to take all of those questions into consideration.
So I'm just clarifying, you said that the company sales would all need to be to Oregon customers?
Sales of securities.
Oh, sales of securities.
Right.
Okay.
Exactly.
Yeah,
That's a
sales
better
under,
clarification.
yes, thank you for asking that. So the question was sales to, for the people in the interweb, sales to Oregon residents, and specifying that sales of securities, not sales of products. Yes.
Yeah.
I was going to suggest this might be a good time just to encourage people online to ask questions too. I haven't seen anything after the sky is blue.
Okay.
Oh yes, absolutely. So Steve will be reading any questions that are submitted online for our web viewers. So please don't be shy.
Yes.
But you also need to, they have the substantial presence criteria in Oregon also, which says that 80% of your sales or something needs to be Oregon-based or something like that.
So this is interesting. This is also kind of the reverse. There's a safe harbor available under the federal, we shouldn't get into too much into the weeds here, but basically there's a safe harbor that says you are presumed to be operating as an Oregon business if, and then it lists all these criteria, including that 80% of your sales are in Oregon. So it's not true that if you have less than 80% of your sales, then you're knocked out of contention. It's just that if you meet these criteria, then you're presumed to fall within it properly. Okay. So sometimes companies can get a little comfortable that maybe only 70% of their sales are here, but their headquarters are here, their employees are here, they're, are confident that they'll be considered an Oregon business, and can just don't meet the safe harbor necessarily, but can get comfortable that they meet the general meaning of the rule outside of the safe harbor.
But, okay.
Yeah, okay. So it's not hard and fast. It's just if you can get that protection, you want it, because then there's no question about whether or not you properly fell under it. But if you don't get it, it's not the end of the world.
You're talking about product sales.
Right. So let's make sure that we're clear on that point. So when we're talking about sales needing to occur in Oregon, that does not necessarily mean, so like if you're trying to fall within that safe harbor to make sure that you qualify as an Oregon business under the community public offering rules, and so you're saying, okay, I'm headquartered here, I'm incorporated here in Oregon, and I make 80% of my sales or do 80% of my business in Oregon. That does not necessarily mean that you sell only your products only to Oregon residents. It has to do with where you sell the product. So, for example, if you have a shop in Washington and you sell a bunch of products out of Washington, that's going to make a difference. If you are in Oregon and you are a winery and you are sending products all over the United States, that's different. You're still selling in Oregon. So gets a little down into the weeds, but
yeah, what they don't want is a company that sets up shop here and then goes and operates somewhere else. That's what they're trying to avoid. So it's 80% of your business from within the state amongst a few other things, qualifies you for the safe harbor.
So on to
All right.
advertising.
Advertising. So earlier we said that offers and sales have to be made to Oregon residents, and that offer is a very broad concept. It is difficult to square the fact that you can't even condition the market to feel positively about your company to a resident or to someone who's not a resident of Oregon, and advertising in the way we generally think about it. So before you even advertise to anyone, you have to have some sort of confirmation that they are a resident of Oregon. As Drea mentioned, a lot of companies do this by having a website that says at the front page, stop, where do you live? You know, what state do you live in? Or what's your zip code? Or click here if you're a resident of Oregon and click here if you're not. And then only once you confirm that, yep, I'm an Oregon resident by whatever means, then you get behind that first wall and you can see things that otherwise would be, or that are advertising.
And again, just to make the distinction that we were talking about before, we're not talking about advertising your products.
Right.
We're talking about advertising for investment in your company. So this isn't limiting how you can advertise your business. What it limits is your ability to advertise to get people to invest in your business.
But how do you distinguish so that, like, my general advertisement would usually condition the market to view my company in a positive way? Like not my securities advertising, but general advertising, I would want to portray myself as positive and
as a good company. Sure. You would want to be very careful that nowhere on any of your advertising did it even hint that you were fundraising.
Okay.
And that would just take, you want to make sure no one's talking about it at trade shows, no one's doing any of that stuff. It's totally separate. Yes.
So just to push the point, so if it's on your own website, literally you can advertise your product and your services, but you can't even hint that behind this door, by the way, if you tell us you're an Oregonian, we can tell you about our fundraising. You can't even do that, right? So literally, if it were your site, you could say, by the way, are you an Oregonian?
Right.
With no clue, right?
Yeah.
As to why you're asking.
I guess
you could run a contest for Oregonians, maybe. I don't know.
Yeah.
But you can't tell them, right? You cannot hint.
The safest way to do it is to not tell them, to say this part of the website is for Oregonians only, Oregon residents only, and put in your zip code and then you can check out what's there. I wish it was a line and I could tell you what's on one side and what's on the other. It really, offer is a very broad concept and you want to be careful to be on one side of it, but kind of there's this squishy area in the middle where it's like, well, is that really an offer? And how close was it to the advertisement of your product? Or
I think practically speaking, what you're going to see is you're going to see folks making some kind of reference to investing and saying Oregon resident investment. Like there's going to be some sort of reference to it because otherwise it's not practical. I mean, the rules themselves talk about segregating. So you have a couple of options with regard to how you do this. You can either do it on a third-party site. So for example, if any of you have heard of Hatch, Hatch is one of the organizations that is promoting these kinds of deals. And if you go to Hatch's website, Hatch has a place that says, hey, are you an Oregon resident and you're interested in investing? Click here. And then it goes to a page that has about 10 companies listed if you have affirmatively indicated that. But the other option is you could do it on your own website, right? And if you do it on your own website, I think that what the rules say is that you have to segregate those pages. So, it's not on the same page. But I think you're going to see some kind of a reference to investing, and then the people are going to need to certify that they're Oregon residents.
Most websites have an investor tab. So then you can go into that tab and then have a sub-tab.
Right.
Or
Right.
business
That-
section.
Oregon residents type thing, and then go from there, you're okay.
Right. But again, I mean, I think one of the things that so we're talking about web advertising, but we're also talking about like flyers. So if you are, you're the corner shop and you think, well, the perfect way to advertise to all of my customers is to put a sign in the window. Can't do that.
So what happens if I break the rules?
Right. So this is
a good question.
This is a very good. So the question is, what happens if someone breaks the rules? So the way that the securities laws work is that in general, you have to register every time you want to sell a security. There are a bunch of exemptions that say, but in this instance, you don't have to register, and in this instance, you don't have to register. You always want to find an exemption. Registration is having an IPO. It's extremely expensive. So this is an exemption from registration. So if you break the rules, you lose the benefit of the exemption. And then you're just selling an unregistered security, and you've got problems at the federal level and at the state level.
So what we would do in that case is we would look for a different exemption and hope that we could get you to fall in a different exemption.
But is the penalty that I get put into prison because I broke a federal rule, or is the penalty that my shareholders can sue me if they think they've been cheated?
So your shareholders can sue you. And there are civil monetary penalties at the federal and state level. Like, you did this wrong, and now you have this money consequence, and you can't sell securities anymore. You're a bad actor, it's called. I think the only way that there would potentially be criminal liability is if you did this so that you would defraud people. You were intending to steal millions of dollars from widows and orphans, and you did it on purpose. But other than that, I mean, the SEC, for example, only has civil authority, not criminal authority. So you'd be talking about like getting an attorney general involved, and that's for, probably not realistic unless you did something really bad.
So if I'm at a marketing event, can I openly talk about my company and that we're offering this? Or is it something that, you get a business card and make a follow-up phone call and do it privately? I mean, if you can't stand with a flyer, it almost sounds like they're limiting you then to even being able to bring it up in a social event.
Well, so the rule is before you make an offer, you need someone to confirm that they're a resident of Oregon. Mm-hmm. And so before you say something like, my company's fundraising, we're looking for investors like you or something like that, then you need them to tell you that they're an Oregon resident.
Can I see your Oregon driver's license?
Right. Right. Which is not a comfortable, that's no one's going to do that.
Don't need to see the driver's license to make the offer. You can just ask them, and then if you want to sell them, you need to see it.
Right.
Mm-hmm. But at that point, then you could engage in conversation regarding a CPO.
Once they tell you they're an Oregon resident, right? Okay. Yeah. Mm-hmm. Yeah, but I mean, you'd have to be careful, for example, of like telling a big crowd this, because probably someone's from Vancouver or someone's from California, and then you've broken the rules and you lost the exemption, and
I go to prison.
You probably won't go.
Probably not prison.
Yeah, you won't go to prison. But your shareholders could potentially get their money back, which for an early company is obviously a disaster because they don't have it anymore. They already spent it.
Right.
So. All right, one more thing I do want to mention, ongoing reporting requirements. If you go through a CPO, every 6 months you have to post, you can do it to your website, but you have to provide your shareholders with a report. We're not calling it a semi-annual report or anything like that, but it's basically, how's the business doing? How much are the directors and officers making? And then just general things about like how, about the company, but it's an update on how the company's doing. Every 6 months, I think people are going to forget about this. It's in the rules, but 6 months comes around really quickly. And in my experience, it's sometimes like pulling teeth to get people to even file their annual reports, which takes about a minute and a half. This is going to be putting this together and getting it on your website every 6 months is going to be kind of a big job. And I don't know that people are really prepared for how much work that's going to be.
So one of the takeaways in this regard, at the federal level, the Main Street crowdfunding that we talked about that is not yet available has significant ongoing reporting requirements. One of the other aspects of what Claire and I do is we work with public companies, and the ongoing reporting requirements that would be applicable to a Main Street crowdfunder under the federal rules are not all that different than a very mini public company reporting requirements. And that is something that small companies are generally not set up to do, not prepared to do, and they're not generally accustomed to the idea of sharing all that information. Oregon has really tried to pare that down and only require the minimum that they think that, you know, a small company can really bear. But as Claire pointed out, doing a report to your shareholders every 6 months that includes some kind of financial information. The rules talk a little bit about a recent financial statement or a profit and loss statement, and an explanation of the state of the business and your financial condition. Doing a report like that to shareholders every 6 months can be a burden, especially if you're a 1 or 2 person operation. So I think that's definitely something to take into consideration when you're considering whether you want to take on that obligation. And that obligation would continue as long as you have an investor that invested through the Oregon Community Public Offering rules.
They offer it through a convertible note and the note converted to a common stock. Would it still apply?
Yes.
Mm-hmm.
So let's a scenario where you just get 10 investors and go along. At some point, you decide to buy them out.
Mm-hmm.
How do you get the requirements to stop reporting, for example?
Mm-hmm.
Right. Well, so I think that's a great question, because that's one of the questions that's going to come up in, let's say there's a situation where you're just trying to minimize your interactions with so many investors, or, and we're going to talk about this a little bit later, you want to take on follow-on investment and your potential investors don't love the idea of you having a number of small, potentially unsophisticated investors. And you can always do an offer to your existing shareholders and try to buy them all out, but you can't necessarily force them unless you negotiate that at the outset. So, I mean, one of the things that we've talked about, and again, we'll get to this with respect to potential follow-on investment, is that potentially you could do a community public offering and you could have everyone sign a shareholder agreement that provides that in the event that you want to do a follow-on offering, that you, the company, have the right to repurchase those shares. You could buy out those investors, and that's all baked in. That's one way to do it. And so I do think there are ways to address some of these concerns, but again, that all, as soon as you start, again, I think the idea of the community public offering is that maybe people can do this themselves, and they can do it without engaging attorneys that would need to draft all of these sort of specific things. And so again, it potentially increases the cost of doing the offering itself.
So what you're saying is, if you go into the CPO system, you have to start planning a way out of the system even before you make an offer.
So the question is, at what point do you have to plan how to exit from your CPO investors? So if you want the option to buy them out at your, whenever you feel like it, then yeah, that you need to set that up at the front end. You can always hope that they sell to you, or that they, but
assuming your company is successful.
Right. Yeah, there's some that you're not going to be able to track down. There's some that are not going to want to sell because they always say no to stuff like that. I mean,
if they sign an agreement,
right,
then you're both bound by that agreement.
Right, and if the agreement says, in 18 months, I can buy your shares for the price you paid plus 8% or whatever it says, then right, they're bound by that agreement. But that's not something that, it's something that lawyers spend a lot of time very carefully crafting, and it's not necessarily something that people are going to write themselves and have it be enforceable.
No one case will suit all people or companies or anything. So
And but again, particularly if you're looking to take on additional investment down the road, it may very well be worthwhile to think about some of those contingencies before you take on a single community public offering investor.
A couple of the Hatch companies did that. When we went to their CPO at Hatch, they had those clauses already written up. So any investor, it was just part of the paperwork that they had to sign.
Yep.
You also want to be careful too, because you are working with unaccredited investors who are not necessarily savvy to how it works.
Yeah.
You also might want to have something in there that will not allow them to show up to your workplace every day and want to look at your books and sit and have lunch with you, because that can happen too. So there's little things on the side that you want to make sure you cover right up front, so everybody is on the same page.
Yeah.
And they will do that.
Right. So for the benefit of our web listeners, the comment was just that you may also want to bake into your agreement what the investor's rights are with respect to contacting the company and asking questions every day. And I think, one of the concerns potentially with taking on non-accredited investors is that non-accredited investors may not be as familiar with the typical structure of an investor issuer company relationship. And they might think, in my example where you have the pie shop, they might think, well, my role as an investor is to have a say in what kind of pie you make every day. And that may not be something that companies are prepared for. So
we were joking about a local company that had an investor who refused to leave, saying, I'm an owner and you work for me. And, it's easy to picture something like that happening.
Yeah.
$2,500.
Right. For a maximum of 2,500.
Right.
It could be 100.
All right, so I think we've already hinted at this a little bit. Who is going to use this type of offering? Like I said, in general, we think that this is potentially useful for the hyperlocal company. Obviously, we have all of the location requirements, but it's also a matter of having the access to people who are interested in investing in your company. And I think there are a couple of things there. So the representational pictures on this slide are the brewery. So we have your neighborhood brewery where, people come in and they say, I love this brewery, love coming here every weekend. This is my pie shop. This is there's a new cafe and cat cafe in Portland called Purrington's. And I, you could see people kind of saying, all right, I really want to get behind this. And I'm maybe less interested in seeing whether I can get a 10x return than I am in seeing this company succeed and having it be there every day so that I can go. And then the possibility is that you're able to potentially turn your customers into investors. And in that regard, it's sort of an investor pool for you. Yeah, Steve.
I have a question from online.
Please.
Also from Tom. This is not about the sky. So I don't see the advantage of this kind of funding over something like the Mercy Corps Northwest or the Craft 3 style alternative type loans. I think that's the micro business loan. I'm not really familiar, but you can do up to like $25,000, but it's a loan, it's secured, etc. So could you comment on the differences?
Sure. Well, I think in general, so the question is between getting a small business loan of one flavor or another versus crowdfunding using this strategy. I think generally, if you can get a loan and the terms aren't too onerous, that's a pretty good way to do it. There are some advantages to crowdfunding, like Dora was mentioning. You've got people excited about your company, and you don't really get that with a loan necessarily. But in terms of ease of administration and obligations going forward, if you can get by on 25 grand and the loan is available, comparing that to crowdfunding 25 grand, there's no contest. The loan is far superior, unless you are looking for some of these other benefits that don't relate to the ease with which you want to conduct your business going forward.
And, some of the things that we've heard from companies that are excited about this is that for one reason or another, a traditional loan was not an option for them. But they felt like they had a support base, and they had folks who would be interested in seeing them go forward but the traditional lending avenues were not an option for one reason or another.
I get that question from growth, early stage growth companies too, and that's exactly the problem. That the microloans usually are for a going concern. Oh, I'm a restaurant. I need to buy a new stove.
Right.
I have revenue. I can show the banker that I can pay this off. On the other hand, I mean, the standard advantage, in spite of the hassle of the equity, is I don't have to pay it back. Right. I mean, that's the advantage of doing this, assuming you don't want to buy your folks out later, right?
Right. Yeah.
But I mean, that is the traditional equity advantage. But yeah, as you're pointing out, it comes at a real cost.
Right. Right. Yeah. So some companies. Oops. Back one.
Sorry.
So just quickly touching on the companies that won't or shouldn't use this. 250 grand. It's a lot for some companies. It's not a lot for a lot of companies. There are some startups who that's an extremely short runway and they can't get a prototype made or, you know, pay the people they need to bring onto the team or whatever. So if there are a lot of companies who this won't be an option just because it's too low of an amount. Companies that want to raise money from professional investors, we've talked about this already, but investors really don't want to see a cap table with hundreds of small, unsophisticated shareholders because they take a lot of work. They're extremely high touch. They're far more likely to sue. And, you know, it's just they want a very clean cap table, understandably, and don't want to deal with the riffraff. So you're presenting something that's already going to be a difficult conversation if you're talking to a VC. You know, why do you have $100 investments on your cap table already?
And we have heard comments from local investors, from the seed fund, for example, that they say, you know, we see the need for this kind of funding for certain small businesses, but what we don't think that the type of company that we are likely to work with is probably the type of company that has done a community public offering. It's fundamentally a different goal. I've also seen some different comments from venture capital funds just talking about the process of cleaning up a cap table of 100 small, potentially unsophisticated shareholders. So I think that one of the very real considerations needs to be, okay, so if you're thinking about taking on follow-on investment, either you need to build some things into the structure of your community public offering to manage that, but also be very aware that this may be a red flag for potential future investors. And one other thing that's worth noting here is just that I think that sometimes, even though this may have been a perfect capital raising opportunity for a particular company, sometimes angel investors, venture capital will look at this type of a raise and say, you know, why were they doing that kind of a raise? Does that mean something about the company? And it may not, but you may need to be prepared to explain that if there's a reason that you weren't doing a more traditional raise.
Right. Yeah. Also, we should note that you can crowdfund under this. You can crowdfund debt as well. It doesn't have to be stock. It's not nearly as cool to be a debt holder of a local Portland company. So people are going to be a lot less excited about that. The shareholder part is really what sells this. But you know, we already talked about having a shareholders agreement, terms at the front end that say I can buy you out at such and such price and such date, or you can just raise debt and then you don't have a cap table with lots of little shareholders.
An online question that's sort of in the category of who fits it and doesn't. Can this process work for equity in a project-based venture, say some sort of real estate development project assembled by another entity?
Right. So there are only a couple of exclusions. Companies that just categorically can't qualify, other than companies that aren't Oregon companies, but no blank check companies. So companies that don't have a business plan. No investment companies. There are tons of exceptions to the Investment Company Act, so it's not too hard to not be an investment company. But if you're fundraising so that you can go invest in an LLC that's going to do some real estate development or something, that might knock you out. But in terms of, and extractive industries as well. You can't be oil, gas, mining. But in terms of, we want to fundraise, we're an LLC in Oregon, we want to fundraise to build this specific building. Yeah, that's fine. You can absolutely have the purpose of your raise be something specific, and the company doing the raise is the company doing the work.
So I think the last piece on that slide is am I jumping ahead?
No, go for it.
Is just that companies that may have trouble following all of these rules should consider carefully whether this is the right way to go. And part of the reason for that, I mean, again, so in our world, generally, if most of your investors are accredited investors, we can find another exemption that we could probably fit an offering into if the exemption that we're looking at it doesn't work as well. But in this case, so if you have a lot of investors that are not accredited investors, there just are not as many exemptions out there. So it's pretty important to make sure that you're really falling squarely within the rules. And sometimes that can come down to manpower. So it can come down to, whether, if it's a 1 or 2 person operation at the company and you're thinking about taking on some of the ongoing reporting requirements for example, that may be a bit of a challenge. Mm-hmm. So just a few takeaways.
Mm-hmm. So there are reasons that people are doing this, and there are companies that are doing this in Oregon and 26 states across the country, and they're raising money successfully. And that's a big advantage. There are companies that maybe don't have access to traditional investment, don't have access to a loan for what they want to do, and they get money to move their company forward. And that's pretty exciting. There's also, we see this with Kickstarter a lot. The community public offering is new enough that maybe we'll see it in the future, but there are tons of companies that got to start on Kickstarter with some weird product, and then all of a sudden it's 1,000 times oversubscribed, and now people are really interested in what else the company's doing, or that's the powerful thing. Being able to show a lot of support very quickly is extremely powerful in terms of getting attention from other areas. It would be pretty fun to be a shareholder of something you like. So if you own a piece of the coffee shop down the street, guess where you're going to go get your coffee? This is a good way to, like Drea said, you convert your customers to shareholders and your shareholders to customers. And if you're trying to appeal to people who are in your neighborhood anyway, that's a pretty good way to kind of hook them into coming back to whatever your company is. And then people are writing about these companies, talking about these companies. This is definitely a cool space to be in right now. And that's not without value. People will want to talk about, how is this working for you, and tell me more about your company. And that's something to keep in mind too.
And I think we've already talked about most of these, but some of the downsides, the administration and obligations that are going to go along with actually doing this type of offering. Everything we've talked about with respect to small, potentially unsophisticated shareholders and the challenges that may bring, and then also potential securities law liability. That doesn't come up if you're doing a Kickstarter campaign, for example. So I think that particularly for certain types of companies, we see sort of the small, hyper-local, small business model perhaps more than what we consider kind of a traditional startup that's looking to make multiple times and have an exit at some point down the road and take on additional investment. This may not be quite the right fit for the traditional startup in that regard, but I think there are potentially always exceptions to that, and there may be ways to draft around that as well.
Does it matter if you have one unsophisticated investor or hundreds of unsophisticated investors in terms of reporting?
So it depends what exemption you're relying on. There are some exemptions where all, like Main Street crowdfunding, which Drea talked about years ago now, but where all your investors have to be accredited. You can't have even one single non-accredited investor. And that changes. There are some exemptions where you can have up to 35. There are some where if the offering itself is really small, then maybe some of those investors are non-accredited. But it really just depends, and it takes a little more thought because those investors are thought to be less able to make good decisions about investment.
So how do you deal with family and friends investments? Because often family and friends, I take it, would be unaccredited.
Right. Frequently, right. So there are exemptions that you can rely on. If you want, well, so is your question like if you take a family and friends round and then later have family and friends on the cap table and you take professional money or something?
Yeah.
Yeah, so sometimes that needs to be cleaned up, depends how many people invested.
Cleaned up means you need to buy them out.
Or, so for example, I have used a strategy in the past where there was a big group of unsophisticated investors and we moved them all into an LLC. And so the only shareholder was the LLC. And they were all unit holders of the LLC. But that took a lot of time, you know.
And they all have to agree to that.
Right, yeah.
Also.
Right. So you're talking about legal fees and probably accounting fees. And you know, is that realistic or is that a good idea for the company? But it's possible, and it's just a matter of having your exemptions really carefully lined up, and you know, I'm going to use this one, and then that's going to give me 8 months of runway, and then I'm going to look for VC money, and it just takes some time.
In terms of the community public offering specifically, you need to affirmatively select that you're doing the community public offering. So you would have to decide that at the outset. So for example, if you decide to do a community public offering, you are going to file some documents with the state, and so it's going to be on record with the state. And even if you actually had one unaccredited investor and all the rest were accredited investors, all the rules and regulations that apply to community public offerings, because that's the exemption that you selected, would continue to apply. So that's, you know, you kind of, it's some about planning in advance.
Another online question. What type of ownership structure does your company need to be? S Corp, LLC, C Corp?
So the question is, what sort of ownership structure do you need to have in order to do a community public offering? And
you can be a C Corp or an LLC. I don't think you could be an S Corp because of the number of shareholders. Right. So, I mean, that would probably knock you out of the running.
So that brings us to the end of the formal portion of the presentation. If there are any other questions, we're happy to answer them, or if there are any other web questions, which it looks like maybe we're good on those.
Sort of switch back here and see if we can get any more questions. Voila, there we go.
Okay.
More questions.
Step into the, you see yourself.
Seems like the initial valuation would be a little tricky. So $250,000 worth of stock in my $25 million startup coffee shop.
Right, right. Yeah, and you know, investors or entrepreneurs are notorious for overestimating the value of their company by several orders of magnitude usually, and they, you know, they get to say, they're not talking to a lawyer or talking to a consultant or someone who's going to talk them down from, yeah, they could say that, you know, what you're really buying is 1/100th of 1% of my awesome company.
And that's one of the disclosures that, like, you're required to disclose in your disclosure documents to investors what sort of proportion of the company they're buying. And one of the things that we don't know, you know, at what point, if you sort of grossly misestimate what proportion of your company that is, at what point that sort of approaches fraud. And yeah, I mean, I think that's definitely, the valuation question is definitely a tricky one. Yeah.
So question, if a family member gives you, I just, for lack of a better term, a gift, say $5,000 to go toward grant writing. Mm-hmm. That would be more come under the bootstrapping kind of a friends and family helping. we're not offering anything, and they don't want anything in return. It's just a gift.
Yeah.
So there's no
totally
reporting. We
No.
don't have to worry about.
outside of the securities laws entirely.
Right.
Which
Yeah.
if you
So the
can
question
get
there
it,
was
yeah, that's
about like if
better.
a family member essentially gives you a gift in connection with your business,
Mhm.
and if they're not getting any sort of ownership interest in your company, there may be other things that would apply, gift and all sorts of other sort of rules that we're not talking about today. But as far as the securities laws, you're outside of the securities laws. Other questions?
What do you estimate the legal fees to be in something like this? Right, 'cause if you capped at $250,000, I can see it easily creeping $8,000 to $12,000 by the time it's all said and done. It's a pretty big percentage of money you're raising.
Yeah,
Right.
absolutely.
It is. And they did, oh yeah, I keep forgetting. Yeah, so the question is about legal fees and how much that.
Well, and all
potentially-
other fees.
Or,
as well.
yeah, professional fees associated with getting this offering off the ground. And yeah, those could be substantial, and they're not going to vary based on whether the raise is successful or not. If you raise $8,000 and your legal fees are $8,000, well, you didn't raise anything, did you? But yeah, I think 8 to 12 is probably a good. So the reason is that as professionals in Oregon, you have liability as participating in an offering of securities. So when the company is bankrupt and there's only one deep pocket and it's the lawyer, guess who they're going to sue? And so lawyers are, and other professionals, not just attorneys, but are very careful to have control over what's said or not said, and to make sure that they're not signing on for any future liability. So you're not. I don't think you're going to find a lawyer in Oregon who's willing to kind of do it halfway or do it cheaply. And that should be a red flag anyway.
And there may be some support with the incubators and with groups
Right.
that are specifically trying to facilitate this. I think that there are some. I think there are some legal advisors that are working with some of the incubators, and I'm sure that the key there is to try to facilitate that. One of the things that we've talked about is like maybe we'll put together form documents that could work for most people, that would maybe have a shareholder agreement that would have a provision that would allow for repurchases, and trying to control costs that way. But I think that it's unlikely that you could get away without some kind of offering costs in that regard. Other questions? Well, thank you
Yeah, thanks
so
very
much for joining us, for having us today.
All right. Well, hey, thank you,
Certainly.
Drea.
Yeah, thank
Thank you very much. Thanks, everyone who joined us online. Also, I think that's a wrap for now, but I should mention another Tonkon Torp thing we have coming up. It's either March 11 or 12, I forget, but we're working on a legal clinic. So stay tuned, a chance to talk to an attorney, more details to come. That's coming up. And also I have to mention the pitch for cash. We're doing the West Side Pub Talk March 3rd, and basically the crowd is going to vote, different kind of crowdfunding, and a winning pitch is going to get $500. So check it out on the OTBC website, otbc.org. And hey, come pitch, and of course bring all your friends, because it's an audience vote. So that's the idea. So check that out. Aside from that, I think we're a wrap for today. Thank you all.
Thank you.